Bloomberg Audio Studios. Podcasts, radio, news. This is Bloomberg Businessweek Daily, reporting from the magazine that helps global leaders stay ahead, with insight on the people, companies, and trends shaping today's complex economy, plus global business, finance, and tech news as it happens. The Bloomberg Businessweek Daily podcast with Carol Massar and Tim Stenivek on Bloomberg Radio.
Yes, we finally got the monthly labor report, which was supposed to be out last Friday. We've talked about that. Today's data showed U.S. payrolls rose in January by the most in more than a year. The unemployment rate unexpectedly fell, suggesting the labor market continued to stabilize at the start of 2026, and yet not so fast, Tim.
The U.S. labor market coming off one of its worst years for hiring in decades. Revisions to employment figures showed the nation added 181,000 jobs last year. That's the lowest annual total outside of recession years, going all the way back to 2003, that averaged out to just 15,000 job gains per month. That's down from an initially reported 49,000 pace. This according to data that we got today from the Bureau of Labor Statistics.
All right, with more on where we are exactly in the U.S. labor market, because it feels a little confusing. Constance Hunter with us, chief economist at the EIU, the Economist Intelligence Unit. She joins us from Wellington, Florida. Hey, Constance, good to have you back with Tim and me. So January stronger than forecast. Revisions show a little bit of a different picture. What's your read on the U.S. labor market and why?
Yeah. So, I mean, for those of us that had forecast a recession in 2025 because of policy uncertainty, because of tariffs and other changing policies, I suppose one could say it feels a little vindicating because we did have a bit of a labor market recession, although other aspects of the economy were firing all cylinders. And I was at Davos last month, and the thing that I heard over and over again from companies, and not just U.S. companies, was we put ourselves on hold in 2025, and we are done with that. The tariffs are bad. They're worse than was originally expected, less bad than originally announced. And all of the other policy uncertainty, I think, to borrow a phrase, the corporate leaders are getting uncomfortable being uncomfortable. And so they're just viewing of it's time to get on with it. But last year was very much a stasis year in terms of hiring.
Yeah, I'm wondering about long-term implications of this. I mean, because if we think about it from the perspective of immigration in this country and the way that the labor force will be changing in the coming years, where workers are going to come from, especially for certain jobs in the trades, for example, in construction, in home building, which we know this country desperately needs. What is your view there?
Yeah, well, I would add to that home health aides and
good point. An aging population,
right?
yes.
So, yeah, well, if you look at the BLS projections of the jobs that require the most absolute increase in workers and the highest percentage change of workers, healthcare has been in that list for at least the last decade. And of course, we're also going to need construction workers to build homes. And a lot of these professions draw upon an immigrant population. So it's certainly, I mean, to borrow Powell's phrase, which is still apt, we're in a very curious balance in the labor market. And of course, if we have fewer or lower population growth, wherever that comes from, we know that you have to make up that for potential GDP in terms of productivity. And while we seem to be in the midst of a pretty solid period of productivity growth, that lack of labor force growth is a long-term problem.
So, yeah. So I'm really wondering, I think about, you are currently a board member on the National Bureau for Economic Research. They are the official, we all know that, the official arbiter of recession. So the start and the end dates. Where are we in this business cycle? And as you look at these longer term trends, maybe with the U.S. labor market, what does it possibly mean in terms of our economic cycle, how that might change, and maybe how it might be more stressed in the future?
Yeah, well, I mean, certainly if we look at labor force growth, that's generally speaking more of a cyclical thing. A structural thing. However, when we look at what happened with COVID, right, we had a big decrease in the number of people entering the country during COVID. We had some makeup and a big increase for several years, and now we're at this place where we're not having that many people enter the country. That has distorted a lot of the data. In addition, when we look at the labor market data, it's also distorted by the layoffs during the pandemic, the rehiring, the frenzy to rehire, the fear and labor hoarding that existed for a while. And so as I look at the business cycle, what you're forced to look at is things other than the labor market, in part because that data is so distorted. And so if I look at something like corporate profits, they're actually looking pretty strong. And we've never entered a recession when corporate profits are growing. Usually corporate profits begin to decline a little bit prior to a recession. It's a really important indicator. With that said, the economy has also withstood massive shocks last year, not just on the labor force side, but again, on the tariff side. And we seem to be sort of plateauing in terms of the volatility in that regard, right? We seem to be sort of reaching this sort of equilibrium, albeit with higher tariffs, that I think firms are going to be able to better plan. And so I would say, if we were to make a baseball analogy, it looks like we're in, I don't know, the 6th or 7th inning. It's hard to say how much AI and that diffusion of AI is either going to extend the expansion or perhaps cause some significant disruptions.
You know, speaking of potential disruptions, we have to end with talking about geopolitics. We're going to be talking to Anne-Marie Hordern in just a minute. She's actually in Venezuela. You've been a member of the National Association for U.S.-China Relations since 2004. Geopolitics, not just between the U.S. and China, but the U.S. and the Middle East, the U.S. and Canada and Mexico. What relationship, in your view, could be one that, if it does unravel or if it does change, could be the most damaging to the U.S. economy and the investing economy?
Well, look, and I'll add Canada with Mexico. Since NAFTA and then the USMCA, which I must point out is really the TPP, right? So the Trans-Pacific Partnership, to which Canada, Mexico, and the US were all a party, fixed a lot of the problems with NAFTA. And so the USMCA really pulled from that agreement that took years to negotiate. And these trade relationships are very deeply integrated. If in the renegotiation of USMCA, we see a breakdown in that would be deleterious to the real economy in the U.S. and, of course, would then impact capital markets.
Great stuff and great setup, because we're going to actually even be digging deeper into that relationship between the U.S., Canada, and Mexico, because President Trump's certainly pondering maybe something else. Always appreciate it. Constance, be well. Constance Hunter, she's chief economist at the Economist Intelligence Unit, joining us there from Florida.
Stay with us. More from Bloomberg Businessweek Daily coming up after this.
You're listening to the Bloomberg Businessweek Daily podcast. Catch us live weekday afternoons from 2 to 5 Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app, or watch us live on YouTube.
So, folks, it's often all about the outlook, often for investors. And so shares of the global designer, manufacturer, and provider of energy, tech solutions, and other power products, we're talking about Generac, they're rallying today, top gainer in the S&P 500, after the company forecast a 2026 EBITDA margin range with a midpoint above analyst consensus. The street weighing in, KeyBank, noting that despite net sales for the fourth quarter missing analyst estimates, shares will trade higher on 2026 outlook and positive data center developments. Shares of Generac, by the way, what is wrong with me? I think I need a new generator is basically it.
I like that.
They are up nearly 60% year to date and is the third best performer in the S&P 500 this year. We are delighted to have back with us the CEO of the company.
Aaron Jagdfeld is chairman, president, and CEO of Generac, joins us from Wisconsin. Always good to have you on the program. A day like today, the stock, the best performer, as Carol mentioned, in the S&P 500, up double digits for the year already. Investors are looking through this clearly. They're all about the guidance, but just share with us why the earnings miss when it comes to the fourth quarter. We're going to work on getting his connection back. We're speaking with Aaron Jagdfeld, chairman, president, and CEO over at Generac. Go ahead, Aaron.
See, we're all having energy, right? We all need a backup generator today.
I guess we need our generators to kick on here. Sorry about that.
No worries.
Okay.
I lost the program.
Hey, I was just asking, obviously investors looking through that with today's stock performance, but why the miss in the fourth quarter?
Yeah, so the back half of the year, we actually had a lot less outage activity. So our residential business, for portable generators, home standby generators, really depends heavily on Mother Nature, honestly, to help us drive demand for those products. And so it was a very quiet back half of the year, the fourth quarter in particular. Back half of the year was 90% lower in outage hours versus the year before. So sometimes that happens, and we guide based on kind of average outage activity, and we got a lot of below outage activity in the quarter.
Well, it's interesting. So what gives you confidence around mid-teens growth when the weather has been the primary culprit for weak residential sales in 2025?
Yeah, so on the residential side, obviously, we think a return to normal outage environment that will happen. I mean, we will get ice storms again. We had one in January, right, with Winter Storm Fern. So we're off to a good start here this year. And so we feel like, we're going to return to more normal kind of outages and more normal patterns, if you will. We've got some pricing in there as well. The consumer for our products is pretty healthy still. I think there's concerns about the consumer across the broader economy. But when your power goes out, these products tend to become a priority for households. So, we're not very worried about the consumer's health, at least for our category.
Yeah, Aaron, explain the consumer behavior here. Is it that a consumer without a generator goes through a power outage in the middle of winter or the middle of the summer and says, I never want to experience this again? And, when they get power back, they call somebody to install a generator? Is that how it works?
You've got it right. And in fact, I would just point this out. Winter outages tend to drive people to that point a lot faster than summer outages.
Yeah.
I mean, when you have an outage in the summer, maybe it's nice enough and tempered enough outside. You can open the windows and you can kind of push through and survive in the dark if you had to. Winter is a whole different ballgame. If you lose your power in the wintertime, especially if you live in the northern states or in this case with Winter Storm Fern, even in the southern states where you had, just tremendously cold weather, you get pipes that freeze, you get a lot of damage in your home, and a lot of things just, your home becomes unlivable.
There's kind of an SS moment there for Tim.
Preaching to the choir.
It happened to him, no power during the cold weather. Hey, what I want to ask you is investors are really noticing the forecast, your 2026 EBITDA margin range. How much of what's going on, the growth, the magnitude, is it all because of data centers?
Yeah, I mean, obviously, largely the headline here is our entry into the data center market. We started shipping products, our first products in the fourth quarter, and we're ramping. We're going to scale this year. We're having some very meaningful conversations as we work towards final contract negotiations with a number of hyperscale customers. And, this is going to be, for us, it's a generational opportunity. The backup power that is required by each data center site. I mean, you can literally have hundreds of large gen sets sitting there waiting for outages to happen. And the project sizes are enormous, and the opportunity is equal to that.
Is this all about the large megawatt generators? Is it all about that? That's what the demand is for? I want you to get into what is the AI play for you guys? Yeah,
for the most part. So for us, there's a direct AI play, which is, you build a data center, you need to have backup power because even a second of downtime, there are requirements there, commitments that they've made to their customers, and there are penalties and things that kick in if they can't supply information or the AI models depending on what they've contracted that data center out to do. Basically, they've got to have a continuous source of power. So they invest in backup generators for those facilities, and that's a product that we're new into, and that's a huge opportunity. The indirect side of data centers is pretty interesting, though. And as more data centers come online, you're going to see a lot more requirements for power, right? Demand is going to grow for electricity. We have supply constraints. In particular, there are parts of the grid around the U.S., like PJM, as an example, up in the Northeast.
Yeah.
This is a major concern on very hot days, very cold days. Going forward, you're going to see more brownouts, more blackouts, and that's going to lead, obviously, to more opportunities for us in some of our core products like home standby generators for homeowners and other generators for businesses and things like that.
So we each have a million questions that we want to get to.
You want to go back to residential?
Yeah. So on the grid,
Tim might be shopping for a generator, Aaron.
But there's an interesting thing happening in some parts of the country, and I don't want to get into the details of new laws in New York City, for example, but some places are, years ago, few years ago argued that we want to just get rid of gas lines in general and don't want fossil fuel hookups within new buildings. So new construction in some parts of the country doesn't have any gas. How do you account for that with a product that, you want to have connected to a continuous gas line?
Right. I mean, obviously you can use LP, right? So if you have an LP tank or a propane tank, that works just as fine. In fact, a lot of our installations in parts of the country like Florida, homes down there don't have connections to, a gas line because it's untenable for them to be able to put that infrastructure in. So, what's interesting, like in policy-driven areas like New York, when it comes to let's not have new nat gas hookups, oddly enough, you can still have a propane gas hookup. So, those are the ways to kind of navigate around some of those challenges. And again, you're using it for an emergency, right? This is not a continuous use product. So, I think really cooler heads should prevail when it comes to certain policies like that. I mean, you want to make sure that homeowners, businesses have access to emergency backup solutions, right? Backup power, backup, batteries, things of that nature. And those are the things that I think we've got to be careful of when we do policy-related things like no nat gas new hookups. Sometimes there's unintended consequences of that, and we've got to be careful about that.
Hey, Aaron, you guys have been expanding, and earlier this year you talked about the acquisition of a new facility in Sussex, Wisconsin, and you are quoted in that release saying, "Our commitment to aggressively invest in serving this booming segment offers a generational opportunity," you've used that word before, for Generac, with the potential of doubling our sales of C&I products in the next 3 to 5 years. How confident are you on this? Is it likely more on the conservative side or more on the optimistic side?
Yeah, it's interesting. We've been having these high quality conversations with data center co-locators and hyperscale operators, and there's obviously a massive deficit of supply for backup power generation today based on all of the things that are on the drawing board to go in the ground for new data center construction in the years ahead. So our entry into this market, we came into the market, we thought there'd be some interest in the product, but we maybe undersized that. Yeah. And to be blunt, we went ahead and we acquired a new facility, and with an eye towards doubling our capacity. We said on our third quarter call, we thought we had about $500 million of global capacity to serve the data center market. We now have doubled that to over $1 billion with the acquisition of that plant and some of the other investments we're making. This is we keep using that word generational, but it's true. Sometimes in business, you can be with a company like I have for over 30 years and maybe never see something as interesting as this in terms of opportunity. And it feels like one of those moments that we have got to go after this. And you see it. I mean, look, you see what other industries are dealing with, HVAC, you're seeing other power companies and things that, the infrastructure needed to handle the data center boom that's on the $650 billion, right, of hyperscale dollars that are going to go to work here on capital expenditures in 2026. They're going to go into things like generators and HVAC equipment and cabling and all the things that make these centers real.
Aaron, we only have about 30 seconds left, but a lot to hit just in the last bit of time that we have with you. Yeah. All the challenges of doing this in the United States, doing this domestically, finding labor for this, the biggest challenge for you as you're running this business right now.
Absolutely. The biggest challenge for us is, the continuing shortage of labor. There's no question that, in terms of the number of people that are going into manufacturing from a career standpoint, that continues to be a real challenge. And of course, now with trade policy being what it is, there's a lot of things that are coming back on shore, which is great, but it just puts that much more pressure on, the labor force.
It's a shame you're not optimistic, Aaron.
I try not to be. I try to be conservative.
Listen, we so appreciate it. All the time you always give us. Be well.
Right.
Aaron Jagdfeld, he's Chairman, President, and CEO of Generac.
Stay with us. More from Bloomberg Businessweek Daily coming up after this.
You're listening to the Bloomberg Businessweek Daily Podcast. Catch us live weekday afternoons from 2 to 5 Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
Let's get to the most read story on the Bloomberg in the past 8 hours. It is an exclusive by Bloomberg's Josh Wingrove. It's about how President Donald Trump is privately musing about exiting the North American Trade Pact. This is according to people familiar with the matter, injecting further uncertainty about the deal's future into pivotal negotiations involving the U.S., Canada, and Mexico. We don't need to tell you this is a key trade relationship.
We're talking about the USMCA Trade Pact. Remember, the president was the one who actually signed it into law. We continue to look at it this hour around the globe, the challenging alliances. That's something investors are watching closely, of course. And for that, we bring in Jordan Fabian. He's in our Bloomberg, Washington, D.C. News Bureau. Jordan, what's going on and what is the president considering when it comes to this agreement that he renegotiated during his first term?
Yeah, it's a really good point you raised, Tim. His anger over the previous NAFTA agreement is what produced this USMCA agreement during his first term. And now he's saying it's not good enough. And so there's a few actions he could take. The first most drastic action, which he has asked aides about, according to our sources, is withdrawing the U.S. from that agreement. That would be done with 6 months' notice and would, of course, send shockwaves through the global economy. It would really cause a lot of uncertainty for North American trade. Short of that, there's a July 1st deadline where the parties need to decide whether to renew this agreement for another 16 years. And if they don't, they would essentially enter into these annual reviews and negotiations on the terms of that agreement. So not necessarily going away immediately if they don't renew it, but it would certainly cause more uncertainty to hang over the pact.
So Jordan, so it sounds like a little bit of a clock kind of ticking here. So maybe that's why this is happening. Or I kind of was making some notes. Is this a distraction, a serious consideration? Is the White House looking to provide, kind of create some kind of distraction here? What's really the goal? What does the White House want here?
President Trump has always been about leverage, and right now he's been angry at Canada. He's angry at Canadian Prime Minister Mark Carney for a variety of reasons. Most recently, that speech he gave at Davos, where he took aim at global superpowers without naming the United States, certainly implying it was one who used economic coercion to gain power over mid-sized powers. So the president didn't take kindly to that, and he's retaliating. He's made a series of threats over the past few weeks, saying that he would raise tariffs on Canadian goods if they did a trade deal with China, threatening to not refuse to open the new bridge connecting Ontario and Michigan unless the U.S. gets some sort of concession, among others. And so you could see this as him perhaps amassing leverage in order to gain more trade extractions or concessions on other issues like migration or defense from the Canadians in this ongoing renegotiation of USMCA.
Look, we got to point out that these are the U.S.'s two largest trading partners. They're top buyers of American goods. Because of the trade negotiations, a lot of the goods that go between these countries are actually exempted from the quote unquote Liberation Day tariffs that were announced. And you got to wonder what this means for companies that are trying to navigate this right now. If you're running one of these companies or you handle supply chains for, let's say, an automaker, and you wake up to news like this Bloomberg exclusive, like, what do you do in order to adjust to make sure that you can pull this off?
Well, Tim, I would imagine there's a lot of behind-the-scenes lobbying going on, especially in the wake of this report, because it's hugely consequential for these businesses. In the immediate term, if the deal goes away in the next year or so, they would remove all those exemptions that you just mentioned. And so Canadian goods and Mexican goods are all of a sudden facing much higher tariffs than they do now. And then over the long term, you could see Canada, Mexico, perhaps integrating their economies more closely, or looking to other powers like China to form trade pacts with. And you've already seen that happening with Canada cutting this limited trade deal with China that involved electric vehicles. They're trying to form closer trade ties with the European Union. So you would have this, breaking apart perhaps of this North American integration over the last 3 decades where, companies have really tied their supply chains together across the continent. You could see that begin to unravel if this trade deal falls apart.
Well, and that's what I think about, Jordan, right? It's about trade and an important trade relationship, no doubt about that, but it's also about backing one another on other global issues. So you do wonder, as the U.S. keeps jockeying and changing kind of its rules and relationships, the world is moving on.
Right. And so if you have, Canada doing deals with perhaps China or Europe, you see Europe doing deals with Latin America. Trump has heralded the end of the international order, saying that basically he wants to have a more protectionist economy. A lot of other powers might not agree, and so you see perhaps other free trading blocks being set up while the U.S. builds a tariff wall around its own economy. And I think it'll take years for the economic consequences of that to bear out, but it certainly would herald a huge change.
Jordan, in the past, the president has. Yeah, and look, I think "quote unquote" Liberation Day is a great example of this. The initial news about something doesn't end up being what ultimately happens, and in the meantime, there is sort of a scramble. He's been referred to as tacoing on certain things. You can't predict the future here, but is there any chance this is an opening salvo?
There's a major chance, Tim, and our story is caveated to say that he hasn't telegraphed flatly that he's going to pull the U.S. out, but the mere threat of it is a big deal, and it certainly could be a negotiating tactic. During the first Trump administration, he used the threat of withdrawing the U.S. from NAFTA to get the Canada and Mexico to sit down and negotiate what eventually became USMCA, and so perhaps he's turning to this tactic again to try and force more concessions from Mexico and Canada. The problem is that Trump is an unpredictable leader, and so it's tough for these counterparts to really figure out where his head is at. Claudia Sheinbaum, the Mexican president, I should add, said today she doesn't think Trump will withdraw, but we'll have to see how that works out.
I think, Jordan, it's because USMCA is an acronym that just doesn't work, and they just need to figure something else out new. Just gonna say, NAFTA worked. This one, what would you say?
Well, I mean, it's been around now. This is the third presidency.
Like, what do you say?
No, I mean, this is what it's called.
Crazy stuff. Anyway, great reporting and great analysis by our Jordan Fabian. He's, of course, Bloomberg News White House editor.
Stay with us. More from Bloomberg Businessweek Daily coming up after this.
You're listening to the Bloomberg Businessweek Daily Podcast. Catch us live weekday afternoons from 2 to 5 Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
Real estate services stocks.
Yeah.
Sank today. Investors assessing the company's vulnerability to the newest crop of AI apps and tools that threaten to disrupt leaders. CBRE plunged as much as 15%. Jones Lang LaSalle, JLL, 13% to the downside. Cushman and Wakefield down 15%.
Welcome to the AI scare trade. Let's see what our next guest has to say about it. I'm curious if she's hearing this from clients as she travels around the country. Lauren Sanfilippo is Senior Investment Strategist for Merrill and Bank of America Private Bank. She joins us right here in our Bloomberg Interactive Broker Studio. Welcome back. Good to have you. This AI scare trade. Are people bringing this up, or how do you, I'm just curious what the communications you guys are having around this, if at all.
Yeah, well, you don't know who's next, right? We don't know who's next. But the idea around sort of the clients thinking coming into the year, right, this is a very concentration type risk thing that they were talking to us about. No one was anticipating these sort of scares sector to sector. But now it's more like, where's my exposure? But what tomorrow will bring, who knows on this AI scare trade, right?
Yeah, Anurag on our Bloomberg Intelligence team, he argues that it's overdone, that the market leaders now will come out of this even stronger. I guess the big question that a lot of people have is what this looks like on the other side, and the way that we should be thinking about this technology, not just from a microeconomics perspective and the effect on individual companies, but what's the effect on the actual economy, on productivity? Right. How are you looking at that? Right.
And I think, too, the other thing, like when we first saw the software meltdown as an example, you didn't know what the inflection point would be on the other side. Like, when would this stop? When would the flush stop? So that's a little bit scary. But from the productivity angle, we've always liked what AI could probably complement a workforce. That was sort of like the near-term impact, at least, right? Productivity, that's the long-term story. We're not really sure yet on what AI will bring. The hyperscalers, they're raised or reaffirmed their commitments. So we're going with that, right?
Well, what does that mean, though, Lauren? Like, if you've got investors who say, this AI trade, everybody says they're spending, we see the spend that's happening, but then we also see companies getting hit. Like, what do you guys advise for investors who want to take advantage of the opportunity? I feel like last year we talked a lot about the energy story, but I'm just curious how you guys are advising clients on that front.
Yeah, energy and utilities, that story hasn't run its course, right? I mean, there's still a dearth of energy out there to power this AI data center build out, right? It just got surprisingly physical, even though we were advising around, utilities and industrials and how you actually build out that AI build out. There was still sort of scarce materials and there's more to go with that trade. There's no reason to give up hope on that, right? Most clients are at least market weight, if not overweight, tech generally. So we're more neutral in that sector right now, but I think for all the right reasons.
What about portfolio positioning in this environment and the rotations that we're seeing? A couple of weeks ago, it was small caps. Now there's been concern about some of the laggards, especially among mega cap tech. What's the rotation that you're advising right now?
This has been significant. I mean, really since the beginning of November, right? So it didn't start at the turn of the year, but we have liked emerging markets as an example for some time. And it would have been an opportunity cost to not be involved in emerging markets last year.
So it's more regional than it is in terms of sectors.
Oh, well, we do like the cyclical trade here in the US, right? We still think US equities generally best in class. So yeah,
really?
we have liked a lot of the industrials, for example, utilities.
Look, in the US market, you've been right for the past 15 years or so. But if you look at broader history, it does tend to be more global. Does the more global trade come back?
And sometimes those cycles last longer, right, than 1 year. So yeah, we're not giving up on EM. And actually that market performance.
Developed
we're a little bit less positive on, but I like a lot of those structural stories. I mean, there is a lot to like. Defense as an example, of course, NATO bringing up their targets. There's a lot going on. I would follow those the structural stories abroad.
I want to go back to emerging markets because if you look at the MSCI Emerging Markets Index, it's up almost 12% year to date. So definitely some outperformance. S&P is just up about 1.5% year to date. And then I looked at the MSCI World Index up a little bit more than 3%. Emerging markets can be volatile. We know that's the basics when it comes to investing. Is it a longer term trend? Like how much longer? Or if you advise somebody, a client, to put some more exposure, I mean, it was up 30% last year.
Yeah.
So I'm just curious, like how much or how long a trade might this be?
So that's a good question. Last year, it was a large part of that story was the dollar, right?
Correct.
The weakening dollar added like 7.5% on a trade weighted basis. It was down last year. A lot of that was the first half of the year.
The weakness in the U.S. currency.
That's correct. So we still see the U.S. dollar weakening into year end. But I think the more important part is fundamentally, have you seen the EM earnings chart? It's like best in class. I mean, really, that EM chart is impressive. So we like that fundamental
So increasingly the fundamentals are there.
Yeah, actually, it's right. And that's backing up the performance of last year. And global growth is reaccelerating. Trade is reaccelerating, right? And so there's actually a really great setup. And then to your point, boom bust, that happens with EM, right? Particularly the commodity producers. So you can expect to see that like in Latin America as an example.
How do you, I mean, some of the volatility that we've seen, I think, has been surprising to people early on in this year. But as somebody who deals with the folks over in the private banking side of things, how are they, not necessarily asking you questions, but people on your team questions? Like when the phone rings, what are they asking? What do they want to know?
Yeah, I
do you not want to pick up? No. Depending on the day.
Some days, right? Well, I would say first, I mean, other than last week, right before, just year to date before last week, the VIX really hadn't spiked above 20. I mean, so you had to put it in perspective first on just that one point on volatility, because it seemed like sub themes were getting hit. Like, right, it was just software for a moment,
and then it was Bitcoin.
Yeah, and so it was like it seemed more orderly at first, I would say, and it wasn't really until last week did that calculus change.
Real quickly, 20 seconds, Bill Ackman, 10% of his portfolio now, Meta. Do you guys still like the big cap tech names, the hyperscalers, the Mag 7?
We still like hyperscalers. Yeah, like I said, we are equal weight, but that's just because of their growing weight in the index, right? But I mean, best in class for sure.
All right.
Lauren, always good to see you.
Yeah,
thanks for coming by the studio. Lauren Sanfilippo, Senior Investment Strategist for Merrill and Bank of America Private Bank, joining us here in the Bloomberg Interactive Brokers studio.
This is the Bloomberg Businessweek Daily podcast. Available on Apple, Spotify, and anywhere else you get your podcasts. Listen live weekday afternoons from 2 to 5 p.m. Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.